200 for silver and 7,000 for gold. There are people out there like Michael Oliver talking about a $300 to $500 silver price this summer or this year, and I can't get there with my work, but I don't think he's crazy. My 200 is my best guess of where we're going, but that doesn't mean it can't shoot right through that. There's still fragility in the economy from the pandemic. Fragility plus leverage plus Fed policy error or central bank policy error, where they're not recognizing how weak things are underneath. They're still worried about inflation, so they're not easing. Kevin's trying to pull money out of the system to normalize the balance sheet. In the banking system, the U.S. obviously got some religion in 2008-9, cleaned up the bank's balance sheets. Canada's repeating our mistakes. They weren't leveraged back in 2008-9. Now they're much more. China's a wild card. Japan's a real wild card. In terms of inflation breaks out there, they've monetized their situation so much. And Europe, I still think Europe's banks are more vulnerable. My metals targets are, and I raised those as well back in early June, 200 for silver and 7,000 for gold. I think we had that huge run up in January, December, January into that top, and we've spent the last several months consolidating that in several steps. I think the lows we saw last week or whenever it was, I guess it was last week, those should be your lows for this period, and we come out of that for that whole consolidation. We come out of that, and I think come out of it in a very steep way this summer and into the fall.
And where do you see the miners in that?
Miners should outperform the metals. Those are big runs. If you do the math, you're talking about more than a double on silver and a big run up on gold. I think the miners will outperform that. So I've got targets on SILJ of 90, SIL of 220. My target on GDX is 180, I believe, and my target on GDXJ is 250. So again, if you do the numbers for the gold miners, it's well over a double, I think, and for the silver, it's a triple or more. So big moves, I think, are coming in the metals. Again, people, because of that several month consolidation, it took. There was a lot of speculation and a lot of excitement about them and the momentum. When, after several months of going the other way, it's really hit a lot of people hard in there. And I think now you've got that wall of worry back in there or skepticism where it can overcome that and run pretty hot.
Markets keep rewarding patience in paper assets while quietly punishing anyone waiting for perfect entry in hard assets. As David Hunter points out here, the thesis isn't just higher metal prices, but a phase where miners potentially compress years of gains into one cycle. The overlooked signal is that sentiment damage during consolidation often resets positioning before larger moves begin. Retail usually chases headlines after momentum returns, while institutions accumulate during boredom. Your risk may not be volatility, it may be underexposure when leadership rotates. Next, David Hunter reveals why institutional capital often enters miners only after retail confidence finally returns.
What about the metals, gold and silver? If gold gets up to, what's your number, 7,000?
7,000.
So what does it do in the bust? Does it crater 50%?
I think you could see that much. Somewhere between, I'd say 40 and 50 is likely.
More for silver?
Silver, I'd say, because it's so economic and much more volatile, you could see that 70 or 80 is not impossible.
So that would be
again,
from 200 down to 50 to 75 range.
Yeah, and what I tell people is I'm more comfortable talking percentages because, as you I'm sure well know, there are people out there like Michael Oliver talking about a $300 to $500 silver price this summer or this year, and I can't get there with my work, but I don't think he's crazy. I mean, I think he's got reasons for it, and we're in a very historic period, so I wouldn't rule it out. So rather than pick a number, my 200 is my best guess of where we're going, but that doesn't mean it can't shoot right through that. So but more importantly, percentage wise, I think wherever we go, you're going to see those kind of numbers on the downside.
David, what kind of macro backdrop and conditions need to occur where your thesis would become invalidated by yourself, where you say, you know what, this melt up / bust thesis, I'm changing it because I'm seeing a massive change take place?
Yeah, for sure. A lot of my thesis is the leverage and, as I say, fragility. There's still fragility in the economy.
The most dangerous assumption in bull markets is believing higher prices protect you from drawdowns. According to David Hunter, the real focus should not be terminal price targets, but what percentage reversals reveal about system fragility. That flips the usual precious metals narrative because explosive upside and brutal downside can coexist in the same cycle. Investors protecting wealth should care less about headline targets and more about exit discipline and position sizing. Next, David Hunter exposes the one contradiction inside melt-up thinking that most metals investors ignore until liquidity disappears.
From the pandemic, underlying this economy, there are haves and have-nots, not just consumers, but businesses. So a lot of them are kind of getting by, but not strong. So I kind of do a formula of fragility plus leverage, plus Fed policy error or central bank policy error, where they're not recognizing how weak things are underneath, and they're not, they're still worried about inflation, so they're not easing. Or Kevin's trying to pull money out of the system to normalize the balance sheet when we really need them to go the other way. Those three things in combination is how I think we get a bust from looking at it from a top-down standpoint. How it looks, what triggers it is hard to say.
Well, what I'm saying is what would invalidate that? What would make you change course and say, you know what, I've changed my perspective. I no longer think we're in a melt-up / bust situation.
Yeah, if the Fed reacted sooner, if the central banks reacted sooner to economic softness, and if inflation was down enough that they felt they could react more, they might be able to head it off. We might only have a lesser recession, and they might be able to head off the leveraged unwind that happens very quickly if they misstep. So it's really that. I think that if you see the Fed not misstepping and reacting pretty quickly, then you might be able to head it off. And again, you'd have to see it overseas too, because I think the real more vulnerable places this time in the banking system. The U.S. obviously got some religion in 2008-9, cleaned up the banks' balance sheets, and so it's more. Canada's repeating our mistakes. They weren't leveraged back in 2008-9. Now they're much more leveraged. Obviously China's a wild card. Japan's a real wild card. In terms of inflation breaks out there, they're so, they've monetized their situation so much. And Europe, I still think Europe's banks are more vulnerable. So I think this could be triggered more from overseas, but I think it's going to be worldwide, and we will certainly be a big part of it.
The biggest market risk rarely appears where regulators are already looking. What David Hunter is highlighting is that leverage only becomes visible after liquidity disappears, not before. Policymakers talk about resilience, while quietly watching credit conditions and balance sheet stress for signs of acceleration. If intervention arrives early, the unwind changes shape, but delayed reaction turns localized weakness into portfolio-wide damage. Next, David Hunter reveals why the next shock may start outside the US and spread faster than headlines admit.
Natural gas could go from, $3 to $50. Oil from 30 to 500. Steel will go through the roof, etc. You're going to see something we have not seen in 45, 50 years, in terms of commodity demand far outstripping their ability to supply it, and there's no real quick solution for that.
Well, that balance sheet expansion, that historic balance sheet expansion that you're talking about, is going to turn out to be Kevin Warsh's nightmare when he wants to reduce the balance sheet.
That's why I say macro will trump his plans. It's no pun intended, but the macro, as I say, I view it as we're in the final decade of a super cycle. I define the super cycle as the period between two depressions, the 1930s being the last depression. I think the mid-2030s being the next one. So this bust I'm talking about may sound like a depression, but it's going to be short because of the money, because we have a printing press. And it's a precursor. It's not the depression. But if you take it to its normal extension, you're right. I mean, you're going to have rates, interest rates track inflation. So if you're going to have double-digit inflation and moving towards 20 or 25% inflation, you're going to have T-bills up there at those levels, and you're going to have the long bond that, in 1980 it peaked out at 15. This time probably peaks out closer to 20. You can't solve that equation. We can't service our debt at 5% with what we have now.
When rates become politically impossible, policy narratives usually change before policy actions do. David Hunter's argument suggests the real conflict isn't inflation versus growth, but debt versus arithmetic. Commodity spikes matter less for headlines than for what they force central banks to admit later. Long-term savers often underestimate how quickly purchasing power can erode when financing costs and inflation rise together. Next, David Hunter unravels why attempts to control inflation may accelerate the exact cycle officials claim to prevent.
If that debt goes up, 50% from here, and interest rates go up from 5 to 20, there is no equation. We're lights out, basically, and that's why I call it the end of a super cycle. We're in the final decade. Sometime in the early to mid 30s. The Fed's probably out of the picture before the end of this decade, but certainly early next decade. That means you have no printing press, you have no solution, because the only thing that's kept us going is constantly monetizing things, right? We keep putting out more money, but the problem in a hyperinflationary period is you're pouring gasoline on a fire that's roaring. You can't do it. They won't. The inflation will rise faster than you can pump money. So you're basically, it's a negative effect. And so you'll be stuck with, we don't have the wherewithal to service our debt, which means, and I speak of it in terms of the U.S., but it's basically a worldwide story. I call it the end of the Ponzi scheme that started post-World War II. And basically, we've had success, every successive cycle, or almost every successive cycle, we've had, things go to greater excesses, meaning inflation and debt, et cetera, requiring bigger tightenings, taking us, overshooting, taking us to a bigger depth, where they had to crank it back out to get us out of it. And it's like a buggy whip where the thing gets more volatile each time. You're at the end of that where it just gets out of control and there's nothing you can do about it. It's basically the end, and so it's the end of a Ponzi scheme, where you just find out there's nothing there.
Debt looks manageable until refinancing turns yesterday's assumptions into today's constraint. This is where David Hunter's thesis shifts from market forecasting into system durability. The uncomfortable question is not whether money can be created, but whether confidence survives once creation stops solving the problem. Investors focused only on nominal returns may miss that preserving purchasing power becomes the real contest in late cycle environments. Next, David Hunter exposes the hidden threshold where debt management turns into confidence management.
Okay, so leaving that ending part aside, because that's still kind of far out and it's hard to know, if that can come to fruition. But your bus scenario, we've seen that play out multiple times in history. What is life like? Is unemployment, zooming higher? Are foreclosures? Are we seeing a blend of 2008, 2000, and maybe the melees of the 70s? What take us through what you see in that bust period?
Yeah, I call 2008 on steroids. And again, it's hard to see it right now. So, I can be wrong. But my whole thesis is basically you've got a combination of debt. I mean, I can't state it enough. Debt is so far beyond what it was in 2008. We were highly leveraged in 2008, which is what got us 2008-9. We're so far beyond that now. And obviously, just looking at the Fed balance sheet, for example, it was $875 billion going into October 2008. It got up to $9 trillion in the pandemic and is back down to six or seven. But we're so far beyond. You look at global debt. Obviously, is so much beyond. Where our government debt keeps growing day by day. We're crossing trillions, like it used to be millions. So leverage, again, around the world is so much higher, and a lot of it is sovereign, and I'm not expecting this cycle the sovereign to go under because of the printing press, but still there's an awful lot of debt other than sovereign. And when I talk about leverage, I'm also talking about derivatives. As I say, debt is leverage on the economy.
Markets celebrate liquidity injections long after the balance sheet consequences become structural. David Hunter notes that leverage is no longer confined to one sector. It now sits across sovereign debt, credit, and market plumbing simultaneously. That distinction matters because larger systems can absorb stress longer, but often adjust more violently. Wealth protection is less about predicting collapse, and more about recognizing when stability itself becomes expensive. Next, David Hunter reveals why debt expansion changes the speed of downturns more than their probability.
In the financial system, derivatives are leverage on the markets. And we obviously know there's so much more in derivative exposure out there than ever before. And that enhances on the way up. But boy, does that take things down fast on the way down. And so, we saw how fast we went from everything being okay to not okay in 2020. We saw, October of 2008 to March of 2009, how fast things unwound. I think this one's going to be at least that fast and probably steeper. And people go, well, the Fed won't let that happen, or the central banks won't let that happen. I go, it's actually because of 2008 and 2020 that they're reluctant to go back there again. Powell stated it many times that we're not going to repeat the mistakes of the past. We're not going to do QE infinity ever again. And I'm sure Walsh has similar feelings. He wants to shrink the balance sheet. So what that means is they're going to be slow to react. They're going to be reluctant to react until things really get to a crisis. And by then it's so late that they have to come in with both feet. So it's not that they won't ease early, but it's getting to a right size policy. If you're going to have something very outsized, you have to do more than ever before. And their mindset is to do much less than ever before. So it's a bad combination.
So
what that looks like from an economic standpoint, I would guess we'll see double-digit unemployment. We've got a situation in this country where, there's a shortage of labor in some ways and skilled labor for sure. So I don't think it's one of those things where you're going to see it shoot up to 20% like 2020, that kind of thing. But we could get to double digits, and that'll be very painful.
The belief that central banks can always rescue markets may be the most crowded trade of all. According to David Hunter, prior interventions may actually make future interventions slower and politically harder. That creates a contradiction few investors model. Support expectations rise, while response speed declines. Portfolios built entirely around immediate rescue assumptions can become unexpectedly exposed during liquidity gaps. Next, David Hunter exposes why waiting for official intervention may become the most expensive decision.
The economy, I don't think it's GDP so much that I don't have a number, whether it's going to be, down. I don't think it'll be double digit down, although we could have a quarter like that. It's more the financial system that I think is going to be under the gun. We've got pension funds loaded with private equity and private debt, private credit. because they thought, well, that
do
doesn't
they
give
do
you.
instead of a bailout, do they do a bail-in?
I think what you'll see in terms of the banks, I think you'll see the FDIC will be funded whatever it needs to be funded to cover their insurance liability. Beyond that 250 liability, I doubt in this country you'll see bail-ins. I'm guessing that all that money that's being printed, all that money created by the Treasury, they'll be using it in every creative way they can to keep consumers alive, keep everybody afloat. So in this country, I don't think we'll see bail-ins. Certainly there's a precedent for it in Europe, so you could see it over there.
What
As
about
I
the
tell
markets?
people,
Are you looking at a 2000 NASDAQ style, 80% drop? Are you for this bust period? Are you looking at a 50% drop like we saw in 2008? What is your expectation for the markets?
I believe we could see something along the lines of 80% across, not just the NASDAQ this time, but across the markets.
And what about
And I have people, when I say that, people go, well, what do you think will drop more? I go, if the broad market is down 80%, you don't have to pick one. It's going to be across the board.
And especially when you have, the MAG 10 or whatever you want to call them these days, in every single mutual fund across all, it doesn't even matter anymore.
Yep.
But
when everyone owns the same winners, diversification can become a story investors tell themselves. What David Hunter is highlighting is that concentration risk hides inside products marketed as broad exposure. Financial stress rarely begins with GDP headlines. It emerges where leverage, illiquidity, and assumptions meet. Investors protecting wealth should ask whether their defensive assets are truly defensive or simply correlated later than expected.